Okay, so now we're going to start the unit where we're talking about investment returns, primarily focusing on taxes and a few other things. But we need to talk about the components that can make up a return, especially when we deal with a portfolio that could be of multiple different assets with multiple parts of a component of the total return. Because there could be interest. Interest is going to be taxed as ordinary income. Dividends are going to also be taxed as ordinary income. When you're buying and selling securities, though, you may be buying and selling at a profit or a loss. So then we get into what is cost basis and capital gains, potentially capital losses, which we're going to be talking about in their own right. Because cost basis is basically the principal. You are not going to be taxed on money twice. If money was taxed before being invested, if it was a non-deductible contribution, it will create a cost basis. You will not be taxed on withdrawals of cost basis. Now, how you withdraw cost basis, whether you withdraw your cost basis first or whether you withdraw your cost basis last, that's last in, first out, first in, first out. LIFO and FIFO are important, and we will be discussing them in their own slides shortly. Any non-deductible contribution, any non-deductible investment creates a cost basis, and that includes sales charges and advisory fees and things like that. Individual cost basis per share is affected by stock dividends. It is affected by stock splits and reverse splits. The total cost basis, though, only changes if we add money or take money out. If I invested $10,000 and I purchased 100 shares at $100 a share, but over time, with stock dividends, with stock splits, somehow I now have more shares than I initially purchased. They rewarded me. As a shareholder, they gave me more shares somehow, which we will be talking about in their own units. But I have more shares now. Well, the per share cost basis may now be changing. Maybe I have fewer shares. They did a reverse split. Again, the individual cost basis per share has changed. But I still only invested $10,000. If I'm going to sell the whole investment, it's my overall cost basis that's important. Individual cost basis per share only matters if I want to just sell some of my investment. But we can also talk about transferring of cost basis. Because I have now two imaginary kids, and as I always describe my kids' names, they're named Brian Jr. and Brianna. Great names. My wife would never let me do that, but let's just pretend for this example. And I want to go and give a gift of securities to my two kids, Brian Jr. and Brianna. And a few years ago, many years ago, for when this story will work, I went and purchased $1,000 of Amazon stock. And it's now worth $500,000, $500,000. So when I go and I give this stock, this now $500,000 in value to Brian Jr. and Brianna, they're going to get value of $250,000, $250,000, but they keep the same cost basis I had. I had a $1,000 cost basis, so now that $1,000 cost basis is going to be split between the two of them, and each of them is going to have a cost basis of $500. Meaning if they went and sold it, they're going to have a lot of capital gains likely to pay. But I also could die. And if I died and left my stock to my two children, Brian Jr. and Brianna, well, they would inherit, they would step up the cost basis to the fair market value at death. In this case, they would each inherit $250,000 at a $250,000 cost basis. Meaning if they sold it soon, they likely would have none or at least very low capital gains. Now, I mentioned LIFO and FIFO. The easiest way I think of sort of understanding these is think of it as after-tax money that's already been taxed as a special kind of water. And this water generates oil. And it even is a special kind of oil because even the oil generates more oil. Because the water is growth. The water is the original money, the after-tax money. The oil is growth. So the water, hopefully, will generate growth, generate oil. So I put water in. I put original after-tax money in. It grows more oil on top. Cool, my money's gone up. Okay, so I put more water in. More oil is grown. Even more oil is grown from before. I put more water in. More oil grows. Okay, it keeps going. But as you can imagine from any cylinder filled with oil and water like this, it's never going to look like this. The water's always going to go to the bottom. The oil's always going to rise to the top. The difference between LIFO and FIFO is where you must start taking the liquid in here out of, your account value. With LIFO, you have to start at the top. The last money in is always growth, is always the after tax is always the growth, the bonus, the taxable portion. The non-taxable principal, the water, always sinks to the bottom. The first money in always has to be water. If this cylinder starts empty, it's not just going to magically generate oil. You got to have some water in there first. You got to put your money in first. Annuities use LIFO. With annuities, you must take all of the taxable growth, paying taxes on every penny you're taking out until you've taken all of the growth out. Then when you take more, then you're taking the tax-free principal, and so you're not taxed anymore. Mutual funds, on the other hand, use FIFO, where they start at the bottom here. You start taking out your non-taxable principal first. Once that's all gone, then you start taxed on the growth as you take that out. Now, if you are just going to be taking out all of the liquid in this tube, it doesn't matter if it's LIFO or FIFO, it's going to be identical taxes. The difference here and the purpose here is if you're doing partial surrenders, is where there needs to be a difference between FIFO and LIFO. All of the accounting methodologies, if you do a total liquidation, are going to come up with the exact same taxable portion. Ordinary income. All earned income is ordinary income. Not all ordinary income, though, is earned income. Remember, it must be earned income to be able to contribute to an IRA. Earnings from employment are ordinary income. That's earned income. But dividends, interest, annuity payments, rental checks, if you're like a landlord or something, those are passive income. Those are not earned income. Alimony, though, is earned income. Child support is not. The partner or former partner that is paying alimony and child support gets a tax deductibility of the alimony. It gets written off on their taxes, and the partner or former partner now who is getting the alimony check adds that to their own taxes. But that means it is after-tax money, and it can be used as earned income to support an IRA. Child support, though, is not. It cannot be used to fund an IRA with child support money. And these are taxed at the marginal rates, the progressive rates they're called. The tax code isn't as complicated as most people think it is. Anyone with a staff of accountants and legal experts can figure it out. Yeah, it's not that hard. It's only, 120,000 pages or something. Now, I've got an animation below that goes through this marginal tax rate, the picture, and how it works. But you definitely are going to want to take a look at it, at least to understand how they work for the real world, so you can better explain to clients and help provide them better understanding when they're making decisions. Because I've heard and read some stories, as my animation will tell you, of people who are sort of at the verge of one of these brackets who decide not to make more money because they think it's going to cost them additional taxes, that it's going to cost them more than they make. And so the animation goes and explains exactly how that's never going to happen. These numbers here explain what the taxable portion is in there. Between these two brackets, between 0 and 9,525, is 9,525. The first $9,525 of everyone's income fits in here and is taxed 10%. That's $952.50. The next $29,175 is taxed 12%. The next $43,800 is taxed 22%. The next $75,000 is 24%. The next $42,500 is 32%. The next $300,000 is 35%. And after that, everything above $500,000 is 37%. So take a look at that animation and reach out if you do have any more questions. The marginal tax rates themselves really aren't going to be tested. Understanding what marginal tax means may be tested. Understanding how municipal rates work is tested. And this may help you understand why people who care about tax brackets are interested in municipals, whereas lower income people aren't. It's not as relevant. Capital gains. This is the type of income from selling securities. Long term is over 1 year. That is on securities held for a year and a day or more. Short term is a year or less. They're generally not going to be asking it exactly a year. They're going to make it quite clear that it's either less than a year or more than a year. Capital losses go against capital gains dollar for dollar. If this year I sold something that I had for more than a year at a $5,000 loss, and I sold something else at a $5,000 gain, well, I've got nothing that I've got to pay taxes on this year. 5,000 loss, 5,000 gain, dollar for dollar, they go away. Excess long-term losses, though, not short-term, long-term losses, can actually be written off against ordinary income up to $3,000 a year until used up. Unrealized gains and losses are those that exist before a sale has occurred. No taxes are owed until they are realized. Realized means there must have been a sale. Now, if I lose $9,000 in long-term capital losses this year, and I make exactly $50,000 a year, that means this year of the $9,000, I can use 3 of them, and I'm making $47,000 this year. I make 50, I get to write off 3, I'm paying taxes like I made 47. I can do the same thing next year, and the same thing the year after that, for a total of 3 years of $3,000 apiece. That's the $9,000 I lost this year. Short-term gains are charged ordinary income. That's why they're not very good. Ordinary income is generally higher than capital gains. While long-term capital gains are charged at the ordinary capital gains rate, at the ordinary gains rate. The capital gains rate. Sorry, misreading that there. Long-term realized gains. Again, a sale must occur. I bought my Amazon stock for $1,000. It's now worth $500,000, and except for the potential dividends I got, potential interest, whatever I got, and like that, with the exception of that, I haven't paid a single penny in taxes, even though I've made $499,000 in unrealized gain. Until I or my imaginary children sell it, there is no realized gain, and only realized gain is taxable. There are different types of dividends. Dividends can only be declared by the board of directors. A way of thinking about this is thinking about it, as I always joke, is that the shareholders can't be trusted. Shareholders don't get to vote on dividends because they can't be trusted. But that's actually not really true. They can actually be trusted incredibly well on this. Let's think about it. If you had a choice, and you, as the person watching this, could vote to get free money. If you could vote to give yourself money, how often would you vote no? As I said, the shareholders can be very well trusted on voting for dividends. They would always vote yes, which is why they never get a chance, because they would just pull all the money out of the company. They can't be trusted to do it reasonably. So only the board of directors gets to decide when there's enough money for a dividend for the owners, for the shareholders. There's cash dividends. These are the ones we normally think of, given in the form of cash. Either can be reinvested at no sales charge, or can be received in actual cash. Either way, ordinary income taxes are paid that year, whether reinvested at no additional sales charge or taken in cash, the exact same amount of taxes is paid that year. But if you reinvest it, that's compounding your money because you're not paying sales charge. So instead of that sales charge going to the company, it's going into your account. Stock dividends is a stated percentage of stock that will be given. So the number of shares will increase. A 10% stock dividend with someone who owns 1,500 shares means that they get 10% more, or 150 shares more. So after the dividend, they would have 1,650 shares. It's not directly taxable, but it does affect the cost basis for capital gains calculations in the form of it's going to generally, in this case, reduce the cost basis per share, because now you've got more shares, so your cost basis per share is going down. So when you sell individual shares, you're going to have more taxes to pay, but you have more shares to sell, so you make more money anyway. Dividend payment dates. There's the declaration date. This is the day that the board of directors actually authorizes, actually declares the dividend. And on the declaration day, they are going to announce the payment date. That is the date at which the declared dividend is going to be paid. They are also going to announce the record date. This is the day the shareholder must officially own shares in order to receive the dividend. Now, those are the 3 dates that the board of directors sets. The rules of the market set this 4th one, called the X date. This is the first day you purchase the security and will not get the upcoming dividend. It is the day before, the business day before the record date. must purchase shares before the X date if you want to receive the dividend. With the way shares work is you purchase them primarily, in most cases, in T+2. You have the trade date, and 2 days later is when you actually own the shares. So let's look at a calendar. If they make the record date of Wednesday, if we think about it, if we buy the stock on this Monday, we're going to own it 1-2, we're going to own it on Wednesday. If we buy it on Tuesday, we'll own it on Thursday. Wednesday, we own it on Friday. Thursday, we don't count weekends, so Thursday, we don't own it on a Monday. But here, if we buy it on this Monday, 1-2, we would actually own it on Wednesday, the record date, which means we'd get the dividend. So if we buy it on Monday, according to regular way settlement, we would get it 2 days later, and we would get the dividend. But if we bought it on Tuesday, we'd get the shares on Thursday. That's after the record date, meaning we wouldn't get the dividend. But Tuesday is the first day where if we bought it, we would not get the dividend. Hence, it's called the X date, where the stock is trading without dividend or ex-dividend. Now, what if the record date was on Monday the 19th? Well, if we count back we don't count weekends, remember. We don't count, we only count business days. We count back 1-2. That means if we buy it on Thursday, we'd own it 1-2 days later. We'd own it on Monday the 19th. We'd own it on the record date. So we would get the dividend. But if we bought it the day after that, on the Friday, well, we'd own it on Tuesday. That's after the record date. We wouldn't get the dividend. But the Friday is the first day if we bought it where we would not get the dividend. Now, if you see this question on the exam, you're not going to see it with the Wednesday or the Monday. The dates they're going to give you are almost assuredly going to be December 26th, July 5th, January 2nd, or the Friday following the fourth Thursday in November, as I've given right here. If the record date was Friday the 23rd, well, if we bought it we don't count holidays, remember? 1-2. If we buy it on Tuesday, we get the dividend. But if we buy it on Wednesday, the business day before is the X date, we would not get the dividend. Now, they could ask this in two different ways. They could give the record date and be asking you for the X date, or they could be asking you for the day before the X date. Pay attention to the question. Is the question asking for the last day to buy it and get the dividend? Or the first day where if you buy it, you won't get the dividend? There is also the idea of selling dividends. That is an unethical business practice. You cannot try and convince a client to purchase stock because of the dividend. On the X date, this A stock, is going to actually go down in price by the dividend. So if I try and get you to buy it on Monday, and I come to you and explain, if you buy it now, you're going to get the dividend. But if you buy it tomorrow, you won't get the dividend. But basically what I'm saying is, let's think it's a $50 stock with a $5 dividend. That means you could give me $50 today, and I'm going to be giving you a $45 stock and a $5 bill. It's $50. Or you could give me $45 today, and I'll give you a $45 stock. Seems reasonable on both sides. But in that case, if they seem equal, well, there's no benefit. There's no reason to try and promote this as an advantage if it doesn't actually give you an advantage. But in actuality, that's actually a little worse than that. Because that $5 bill I'm giving you, that's interest. That's taxable. So I'm giving you you're giving me a $50 bill. I'm giving you a $45 stock, a $5 bill, and probably a $1 or $1.50 tax bill. So you're literally down money. That's why selling dividends is unethical. It looks to the client like it might be a good idea, but in actuality it is not, and it is going to be considered a fraudulent activity. That does bring us to the end of this unit. I hope you found it useful and productive, and I will be seeing you again shortly.